Nigeria is at the dawn of a promising economic and financial future. A decade of strong growth, averaging 6.8% a year, has catapulted the nation to Africa's largest economy. According to a Citigroup report, Nigeria will be among the world's fastest growing economies between 2010 and 2050. The foundation of this bright future was set in place more than a decade ago, when the federal government and the Securities Exchange Commission made the development of the bond market a big part of ongoing reforms, undertaking initiatives to improve regulation, governance and transparency. In February 2010, soon after assuming the position of Director General of the SEC, Arun Maote said for Nigeria to realize its full potential, it would need a world-class capital market that is strong, sustainable and well-functioning. It should play a central role in the country's economic development, becoming an enabler for the transformation of the economy, facilitating domestic savings and international investment.
We've had several milestones. First, the establishment of the Debt Management Office basically allowed the federal government to be the example for us to have a benchmark curve, which today is up to a maturity of 20 years. The second is the initiatives that SEC has led itself, which is basically to make sure that our bond markets are similar to other bond markets that are world-class. And that is making sure that there's efficiency in our approval process, making sure that we can support issuers such that the costs that they incur are reasonable, so that we can be as competitive, if not better, than bank lending. The third is to ensure, from a market development point of view, that there are products that help the market.
Nigeria's economic reform program is evident as far back as 2006, when negotiations resulted in the relief of the $18 billion Paris and London clubs' debt. This led to a significant reduction in the external debt of the country, allowing the government to concentrate more on the internal market and development of the local debt market. Not only does the bond market provide long-term investment opportunity for the private investor and long-term financing for corporates at low cost, but the government also uses it as a low-cost financing instrument for the deficit budget. In December 2014, Arun Maote put the total capitalization of the bond market at 9.95 trillion naira, made up of 4.1 trillion naira in federal government bonds, 4.35 trillion in bonds issued by AMCON, and 1.5 trillion naira in state government and corporate bonds.
The need for debt capital in Nigeria is enormous. I mean, we're one of the most lowly leveraged countries in mint countries. I mean, our debt to GDP ratio is like 10%. It's ridiculous. It's low. It's a lowly leveraged institution. So that tells you there is huge opportunity for debt capital.
If the primary aim of the Nigerian capital market is to mobilize long-term funds for investment, as well as stimulate industrial and economic development of the states and the corporate sector, the recent International Monetary Fund's raising of the borrowing threshold speaks volumes about the country's debt capacity. The Director General of the Debt Management Office, Dr. Abraham Nwankwo, in August 2014, confirmed that Nigeria's debt is still sustainable, as the debt to GDP ratio is still below the global allowable threshold of 26%. This offers opportunity to raise long-term money where required.
The bond markets have absolutely been essential for the Nigerian economy. Even when you look back to the colonial government in 1946, they actually issued a £300,000 loan ordinance, and as early as 1960, the Nigerian Broadcasting Corporation did a transaction.
Historically, the bond market has been slow to develop, but over the last 4 years we've seen tremendous growth. The SEC has redoubled efforts to improve regulations intended to protect investors and market operators and ensure the integrity of the market. The results of these initiatives have been encouraging.
The fact that we have about $62 billion in terms of outstanding bond issuance, whether it be I think about 42% is issued by the Nigerian government as sovereign bonds. And we have the Asset Management Company of Nigeria, which is a relatively new institution. that has also issued a lot of bonds. And then we've got the rest, about 15%, that is issued by corporates. So there's a recognition about the importance. That recognition is growing. It's clearly also growing because institutional investors like pension fund administrators recognize that it's a very important asset class for pension fund money, also important for insurance and other asset managers.
Within this valuable asset class, subnational bonds are very attractive to investors due to their liquidity status and low risk. Furthermore, they are tax-exempt and backed by an irrevocable standing payment order from the Ministry of Finance, with, of course, the exception of those issued by Lagos State.
I think one of the key successes of the last 5-6 years is really the way that, firstly, municipalities like the state of Lagos, have come through, begun to use, public debt markets. And Lagos State, over a 3-year period, has raised, close to $1.7 billion. And all of that money has gone into developing public, physical, as well as social infrastructure in Lagos. So we're all very, very proud, when we see that nice Lekki-Ikoyi suspension bridge. It was one of these projects that Lagos has seeded with proceeds from a bond issuance.
What you're seeing now is clearly more interest by state governments. Lagos State has been a particularly good example. Another is corporates who see it as an opportunity to diversify their funding sources from equities, from bank lending. So we're seeing corporate issuance also continue to grow.
The reality is that our market is still a dwarf compared to many of these countries. I mean, the biggest instrument we have in our market is actually the FGN bond. And in reality, Nigeria is actually not a big borrower relative to other markets. I mean, other countries, even emerging market countries, the size of their debt relative to their GDP is much, much higher. So indeed, we have to be sort of mindful of the fact that we are not going to encourage the federal government or state governments or even corporates to just go and borrow money and create debt instruments simply because we want the market to grow.
Compared to other emerging countries, domestic debt markets in sub-Saharan Africa remain shallow. Turnover is generally low and the secondary market is not very active. Domestic debt markets are mainly dominated by government securities, which account for over 75% of total bond market capitalization in the region. One of the lessons learnt from the crisis of Nigeria's unsustainable external debt in the late 1980s was the need to have a reliable domestic debt market as a viable alternative source of borrowing by the government. The capital market should also facilitate the diversification of the Nigerian economy from its dependence on oil, which has mostly been fueled by the oil sector contributing 80% of the nation's revenue and 90% of its exports. However, oil is a finite resource, and it exposes the country to global oil crises that could significantly impact government finances and the economy as a whole. With recent oil prices at record lows, data shows the contribution of the oil sector to GDP declined further to 8.97% in the fourth quarter of 2014, from 10.45% in the previous quarter. The approach taken by the SEC was to put in place a regulatory framework for bond issuance that is world-class, classified as best practice.
Essentially, we have, potentially one of the strongest bond markets on the continent. The government bond market has been, the most liquid end of it, where the government issues on a quarterly basis. They issue across, a variety of tenors, all the way from 3 years issuing all the way out to 20 years. Government typically is issuing on average somewhere in the region of $400 to $500 million of debt every quarter, and has been a consistent and regular issuer of medium-term debt in the domestic market. Some would even argue that government to some extent has crowded out the corporates as well as the subnationals.
The most recent development that comes to mind is the establishment of FMDQ. FMDQ is a platform that allows a more transparent trading of all types of fixed income instruments. Traditionally, bonds were listed on the Nigerian Stock Exchange, although the largest platform for trading those bonds was with the Financial Market Dealers Association. So although they're listed on the Nigerian Stock Exchange, they largely actually traded outside that floor. Now the FMDA has transformed into FMDQ, and the fact that those bonds are, listed in that manner, and a recognized securities exchange with trading details available for all, not just those on the FMDA to see, means that there's a bigger platform, for trading those securities, and that has improved in many ways their liquidity. And the more liquid an instrument is, fundamentally, the more attractive you'd expect it to be.
The caution should always be to ensure that the capital markets reform agenda is to restore investor confidence, as a functioning capital market cannot exist or flourish without investors.
There's some reluctance from investors or some reluctance from issuers. There's some concern for some of the smaller issuers about what the implications of getting a rating are. And without a rating, you cannot borrow in the market. I'm not sure that we should necessarily relax the rules, but I think there needs to be perhaps a lot more education to let issuers understand, that the market is deep, that there's a wide universe of investors that play in that market, and it can be a valid means of them raising the long-term funding that they need for their businesses.
We have come a long way in the last decade, and we now have an FGN bond market, which is one of the most attractive in the world. This is really given an impetus by the listing on the JP Morgan index, and shortly after that the Barclays index, which has made the Nigerian federal government bond one of the most liquid, one of the most attractive, and source of diversification in emerging markets. It's probably, after the South African treasuries, it's probably one of the most attractive instruments you will find in sub-Saharan Africa at the moment.
With the world's attention on government bonds, the attraction of this instrument has not gone unnoticed to Nigeria's corporates and state governments.
Part of what the bond offers you is that it offers you some breather, because if you are in real estate, typically you require medium to long-term funds, because your project cycle typically is between 2 to 5 years. So a 5-year bond gives you the opportunity to run your projects without looking behind your shoulders, that your creditor was going to hunt you down or something along that line. So I think it was quite remarkable at that time, because it was difficult to assess anything beyond 6 to 24 months at that time, particularly for our line of business. So the bond really afforded us a very unique opportunity, to play the way we would love to play in the market, by having funds that we could match with our project cycles and the gestation period of our projects.
The benefits of borrowing from the bond market by state governments showed tremendous growth in the 4 years to 2014. Analysis of data from the Securities and Exchange Commission shows that between 2010 and 2013, 15 state governments issued bonds totaling 524 billion naira in nominal terms, an increase of 272% from the period between 2000 and 2009.
We've been able to create a new market around subnationals and corporate bonds, particularly since 2009, when the market took off. And a lot of that has been due to the fiscal regime introduced by the present administration of President Goodluck Jonathan, by granting tax waivers on non-sovereign bonds. That has really sort of pushed demand on the side of investors, and had made a number of bond instruments, particularly non-sovereign bonds, very attractive. And we've seen remarkable growth since then.
In the subnational bond sector, Lagos State is the largest issuer, with a long-term strategy to fund development through the capital market.
For us in Lagos State, the capital market has played a very significant role in complementing our fiscal resources towards the execution of our policies and programs for the overall benefits of the residents of the state.
Some of the projects include the Lagos Badagry 61-kilometer highway expansion that takes us to the border of Republic of Benin, Badagry. It includes the Blue Line light rail project in the eastern corridor of Lagos as well, to complement access to the border, improve regional trade and commerce and movement of people. It includes the 70 million gallon water per day water works at Adiyun. It also includes the shoreline protection program for the Lagos East area of Goshen Beach to Alpha Beach, where residents are threatened by coastal erosion, and we need to install there a shoreline protection scheme over about 7 kilometers. That was budgeted over a 3-year period. We started late in 2011. We ramped up progress in 2012, and we can do a lot more this year and hopefully finish it next year.
So if you then look at the multiplier effect on the economic growth that we are seeing and the impact of the citizens, living standards are rapidly improving. We are taking more people out of poverty line into the middle class. Lagos is also a service city oriented, just like the city of London, where you have a concentration of all the professionals, be they engineers, accountants, lawyers, who have, found Lagos as that convenient place of abode for them to apply their trade in the West African sub-region. We are the economic and the commercial nerve center of Nigeria, and arguably that of West Africa. So we attract considerable amount of people coming into the city every day. And if we do not stay ahead of the game by ensuring that we put in place an adequate level of infrastructure that can support the increasing population, then we'll have a serious challenge in the city.
In the 2005-2006 financial year, Akwa Ibom state government also entered the bond market, issuing a 6 billion naira medium-term bond intended for infrastructure development.
That's the only bond, and I'm sure you're aware, the state, with the resources it has, in the last 7.5 years, it has developed critical infrastructures that has made the state a destination of choice for most people.
The Commissioner was in agreement that Nigeria's bond market has a place in providing funding options.
Of course, yes. The capital market, it has a big role to play for development of infrastructure, and I think that's the way to go. One of the major problems that you have in terms of development is inaccessibility to funding, and the capital market provides an avenue, an alternative for long-term funds that can be used to develop critical infrastructure. So the importance of the capital market in the development of any society, it cannot be overemphasized. It is really, really important, and it is the way to go.
The decision of the Kaduna state government to enter the capital market came in the wake of the global economic crisis. In 2010, the state was unable to meet all its capital project obligations, and after considering several options, they found funding the long-term projects from the capital markets to be the most well-suited and issued a development bond.
In 2010, we structured a debt instrument of 15 billion naira, and it was faced in 2 tranches. The first is supposed to be 8.5, which was accessed as at 2010, and it has a life cycle of 5 years. That is to say, it will terminate in 2015. This bond, the then administration, when it came, was burdened with heavy recurrent expenditure to the extent that very little capital was left, or very little financial resources were left to execute capital projects or developmental projects. Now, a decision was taken by the state government then that there is the need to access funding from the capital market to be able to finance some key developmental projects. And some of these projects were the Zaria Regional Water Project, The Zaria Water Regional Project is a very important project for our state government. Why? Because it provides water to over 8 local governments that are in Zaria and Zaria surroundings. The funding was meant to just part finance or complement other funds that were put into the project.
Because of the flexibility offered in terms of repayment and payment structure, the Kaduna state government will again go to the capital market for an 8.5 billion naira bond issue.
We identify new projects, mostly in the road sector, which cuts across all the 3 geopolitical zones. And we took consideration of the economic benefits, the connections, the agrarian nature, the need to create jobs, the need to reduce poverty. We identify several roads we said we were going to construct with the proceeds. Then we also we have a few projects totaling about 3-point-something billion naira in the education sector, educational infrastructure. We also believe that education is key. If you want to have an enlightened and a youth that is economically productive. So we identify projects totaling about 3.5 billion in that sector. We said we want to execute. So these essentially are the reasons why we are going for the second bond. And it's supposed to be a 7-year bond, and it will terminate in 2021, November. So you can see, and if you look at the amount that will be paid on a monthly basis from the ISPO, it's just about 190 million, considering the internally generated revenues of the state government, which is in the region of about 1 billion or a little above 1 billion. You can see that it sufficiently provides for flexibility in terms of ease of payments.
The Kaduna state government has accessed funding from the capital market as far back as 1989. At that time, they were in the market for 30 million naira to fund the establishment of the Kachia ginger processing plant. In 1993, they went for the second tranche of another 30 million naira for the continuous running of the ginger factory. Kaduna State also used part of the proceeds of the 8.5 billion naira bond to build a 300-bed specialist hospital in the new Kaduna city. Another area of focus for the proceeds of this bond was the development and construction of major roads and a power plant.
So we felt we need a specialist hospital that should be able to cater for some of these elements at the tertiary level. Now, again, the funding for this project was just to complement other funds that were put into the project to build the hospital. Part of the funds were also again used to develop or to construct some of the major roads, like the Tum-Madakia road. Is a road that is economically viable and socially. We felt the construction of that road will enhance the economic well-being of the people of that surrounding area. We also use part of the funds to provide counterpart funding for an 84 megawatts fuel power project in Kaduna. Again, Kaduna is an industrial capital. You have many industries, and we have power challenges. So in a bid to revive some of these ailing industries that have went comatose because of the power challenges, we decided to build a power plant, an 84 megawatts power plant. So and it's in the process, and we have provided counterpart funding for the 84 megawatts power plant.
Another state government to benefit from the capital market is Benue State. With a total population of just over 4 million people, according to a 2006 census, Benue is the 9th most populous state in Nigeria. Agriculture forms the backbone of the economy, engaging more than 70% of the working population. This has made Benue the major source of food production in Nigeria. To facilitate growth in the state, they went to the bond market in 2011.
We took a 13 billion naira bond. Much of it was used for infrastructure development. What we wanted to do was to bridge the infrastructure deficit in the state. So we took the bond for that. Essentially for water infrastructure, rural roads, rural electrification, and then we wanted to also complete a lot of the outstanding works that we had in the state teaching hospital, and also build 2 mini water plants, treatment plants, which we have completed.
Of the various projects undertaken in Benue State, the water project and upgrading of rural roads had the most notable impact.
Benue is a state that has a whole river passing through, River Benue passing through. And you couldn't justify the fact that you have this huge river and yet there's no water when you turn on the taps. So we did that, and it's a major thing. At least it's also it's having impact on the health sector because people have clean water to drink. So yeah, it's a major thing. Part of what we did with the roads was to improve the urban centers, urban renewal. So yes, it's had a major impact across the state.
Critics have raised fears over the abuse of the subnational bond market. However, in June 2014, Minister of Finance Dr. Ngozi Okonjo-Iweala stressed that state government's domestic borrowing is subject to federal government analysis and confirmation based on clear criteria and guidelines, ensuring that a state can repay based on monthly FAAC allocations and internally generated revenue. Coming up, the investment opportunities offered in Nigeria's corporate bond market. The evolution of the capital markets in Africa has attracted investors to the benefits found particularly in the corporate sector. Even though corporate bonds hold a greater risk for investors than sovereign bonds, they offer higher yields. Within the last 5 years, the SEC has redoubled efforts to provide a dynamic bond market that can supply affordable medium to long-term capital to businesses in Nigeria. Between 2005 and 2012, 20 Nigerian companies have raised about 200 billion naira from the domestic bond market.
Companies need to be able to diversify funding costs from equities to include bonds. So the opportunities are enormous, and with $30 billion of money, looking for where it can put that money, the issuers, I think there's clearly an opportunity there.
So the point basically is that role in which where the corporates come in, right, is where you make interest rates economically viable, and then it makes it attractive for corporates to now issue. It makes it attractive for investors to buy and hold, and then you now look at how do you create some liquidity so that these bonds can actually flow from one investor to another.
You've seen a number of corporates from UAC from UPDC, the property subsidiary of UAC, to businesses like Lafarge Wapco, to NACO, the aviation group, some of the banks, UBA, FCMB, beginning to use domestic bond markets, and you would expect to see over the next few years more regular issuance by corporates in the domestic bond market.
It's clearly also growing because institutional investors like pension fund administrators recognize that it's a very important asset class for pension fund money, also important for insurance and other asset managers.
We were the first to do, say, for instance, I think it was a 7-year corporate bond, which was actually a floating rate bond, right? We were the first to do that. We were the first to do a bond that was actually wrapped by a foreign entity, in other words, guaranteed by a foreign entity to achieve a AAA rating.
To date, the biggest bond issuer is Flour Mills of Nigeria, Africa's largest wheat flour miller and the second largest in the world. According to Jacques Vautier, Group Financial Officer, it came at a critical time for the group when there were huge growth opportunities.
Why did we do that rather than maybe other long-term commercial debts? Different reasons. First, actually it was a rather easy process to do it. Another reason, it is fixed interest rate, and in 2010 when we raised the 37.5 billion, we were able actually to have a fixed interest rate of 12%. And we still enjoy this 12% even now today. So the full repayment of this bond will be at the end of 2015.
We still don't see as much corporate issuances as one would expect. And I guess the reason is because a large number of the better corporates can access funding more cheaply from the banking market. But the bond market remains a viable alternative for such corporates. Generally, you can borrow from the bond market with less covenants than would exist in the banking market.
UACN Property Development Company issued a 5-year bond in 2010, which was oversubscribed by 100% at the time. It was the first and only listed real estate company to enter the capital market.
We floated the bond at that time for two principal reasons. Number one being to repay some of our short-term facilities. Our business is real estate. Typical gestation period of our projects is between 2 to 3 years. So it was critical for us to be able to match our liabilities with our facilities. So what we basically did was to pay down some of our short-term facilities by converting them to a five-year bond, which was what we basically raised. But more importantly, we also applied the proceeds to some of our key projects, which were ongoing at that time. So we had to conclude some of those projects. We had to conclude VMP 2 in Victoria Land. We had to conclude Cameron Green in Ikoyi. We had to take off on our project in Porako, the Vintage Gardens. We had to conclude Granville Estates in GRA Keja. We had to conclude Metro Gardens in Lekki. So we had this pipeline of projects at that time, and we needed to source these funds, to assist in completion of those projects.
UPDC had entered the market at the right time and got a very good coupon rate. C&I Leasing has twice been involved in the corporate bond market. They provide leasing to different sectors with clients in telecoms, oil and gas and manufacturing and distribution, but with their focus largely on transportation assets.
The first bond was 2010, January 2010, and that was basically a convertible that we issued to two potential shareholders. The reason why we did a convertible was that it was a bit difficult to price equity correctly at the point in time because prices were dropping literally every day. So we issued bonds worth 2.2 billion in 2010. And then the other one was a straightforward bond, which we issued, I think it's 2011, where we basically issued bonds to pension funds and insurance companies, which raised about £1 billion. And that one was a straightforward bond carrying a fixed interest rate over a 5-year period.
As in the case of Flour Mills of Nigeria, C&I Leasing required capital to facilitate their growth process.
Basically, we're a growing business, and we felt that the bond market offers us a steady source of funding because we're in a long-term business. We're in equipment leasing, and the typical contracts we sign range from 2 years to 7 years, and right now, for instance, we're looking at a contract with a client at maybe 10 plus 5 years, so that's 15 years. So you really can't do that business with short-term money. So we are always in the market for sources of long-term financing. And the bond market provides that for us.
Asked whether the result of their venture into the bond market was successful, the CEO had this to say.
Oh, certainly it's helped the growth. It's helped provide stability to our funding because with the bond, you basically know what the terms are, you know when the maturities are. We have set up a sinking fund. So every month we collect revenues which we use to eventually repay the bond. So what we do is basically build up towards that maturity and pay it.
The SEC's regulatory reform initiatives led to the review and streamlining of the entire bond issuance process. The outcome is the establishment of the over-the-counter market, the removal of taxes on corporate debt issues, and a cut in transaction fees, allowing firms to raise capital on the bond market at lower coupon rates and offer tax-free returns to investors.
We believe that the bond markets are very, very critical. We believe that we must make sure that if an issuer comes to the Nigerian market to issue, that they feel the same way as if they were issuing in the US markets or in the Eurobond markets. So in the last 5 years, we've streamlined bond issuance, we've reduced the transaction cost so that it's comparable to costs in other jurisdictions. But we've also introduced a number of things that were not in existence in the past. We have a shelf program, which is probably what has helped in reducing the costs. And a shelf program basically allows you to issue several times without having to renew your documentation, except if there are changes.
The SEC has they've done a very good job, supporting the development of the bond market. There's no question about that. There's still some to do, but I think what they've done so far has been fantastic. So regulatory environment has been fine.
We've also had very prestigious issuers like the African Development Bank, a AAA foreign currency rated issuer, the International Finance Corporation, the private sector arm of the World Bank also issue in the Nigerian market. And I think a lot of it has to be in response to the fact that we have a domestic market that they feel comfortable issuing in. But it's also been great for us to have those kinds of prestigious issuers that issue around the world coming to our market. So that has been very, very significant for us in responding to some of their regulatory requirements. One of them being that they issue in markets where they don't have a shelf program that has a tenure. And so one of the things that we've done recently is accept that for multilateral institutions where Nigeria is a member that are AAA rated, that they can actually have a shelf program that does not have a tenure. And that has allowed us to respond to their specific needs.
Arunma Otte had previously made it clear that in addition to having a bond market where institutional investors invest in, it's also important to create an environment where retail investors want to participate. So Nigeria's bond market is not without its challenges. Some Nigerian firms are reluctant to issue bonds because of the high fees and multiple taxes. They may also have been held back by the relative ease with which they could raise capital by issuing equity before the global crisis and sharp falls in the local market. All challenges which have not gone unnoticed by the SEC.
I think the biggest one is really ensuring that there's a good secondary market. The establishment of the FMDQ, the over-the-counter market, should help us create that liquidity such that people can enter and exit very easily. The second one is to have risk management products, different forms of derivatives, because that will help the market grow. And that's clearly something that we expect will be the next generation of reforms that we will encourage in our market. The third is that I think that we need to leverage, or issuers need to leverage this market much more. What we would like to see is greater interest by businesses in the bond markets as an alternative to issuing in equities.
What we should focus on is on trying to grow the volume of bonds that are issued in the market. So the costs of trading are minimal, the costs of issuance are minimal. I guess you can still earn the same amount from a larger issuance when there are more issuances than you can, if there's just one occasional small issuance.
We've always tried to look at the real sector, but unfortunately, the current interest rate environment, makes it more or less, would I say, not unprofitable, but uneconomic, for firms to issue, at, bonds at this sort of, high interest rates. To create long-term money, you need to bring down short-term interest rates. to make long-term interest rates or long-term money attractive?
I believe that some of the challenges is the level of interest rates in Nigeria today. And so when they look at the hurdle rate, they worry about some of the documentation issues, and they're more comfortable with lending or borrowing from banks. While in reality, this opportunity to go directly to the market has other benefits. In addition to raising money, diversifying your funding costs, it can also help your brand. But you can also reach out to a certain category of investors that you would not normally reach out to. I mean, we've got a $30 billion pension industry in Nigeria built up in 10 years. Pension money is looking for assets that are similar to the kinds of liabilities that they have. So there's clearly an understanding from issuers, issues of probably greater capacity from capital market operators so that they can help the issuers structure the kinds of transactions that meet their own needs. There's also just having risk management tools that enable people better leverage bond markets.
Still a few challenges. Apart from the federal government instruments, the other instruments, subnational, corporate, are still not as liquid as investors would like. We would still like to extend the tenor. We would like to see 10, 15-year instruments in this market, but it's a gradual process. We need to spend some time building investor confidence, and addressing liquidity is a key part of this. There's a lot of effort being made. The SEC has recently licensed 2 new exchanges, and we expect in particular FMDQ to take giant strides in creating a market, particularly for the subnational and the corporate bonds. So that's one key challenge we need to face. In terms of listing and trading, there's still, a lot of work has been done by the regulators, particularly in lowering the cost of issues and the cost of, but there's still a bit of work to be done, just to encourage more issuers, particularly in the corporate side of the market, to come forward.
So one of the things we're very, very proud of is the fact that we approved the over-the-counter market, which basically, the FMDQ, which basically allows us to have more trading. Essentially, in the recent past, we've only had trading on federal government bonds. What we would like to see is trading and a secondary market develop for state government bonds, a secondary market developed for corporate bonds. And we think that with the approval and establishment of FMDQ, that we will have a situation where we can have trading on these other categories of bonds or asset classes. And what we expect is that it will create more liquidity, which is one of the challenges that we face in our market today.
The issue has actually been the monetary policy that we've had. We've had a very tight monetary policy. And because of that, it's made it extremely difficult for the private sector to have access to capital, because you have the major crowding out effect, right, of the public sector. The government, for instance, cannot be borrowing at 12%, 13%, and where would you expect corporates to borrow? Where 12 and already 13% is tax-free and risk-free provides any investor a good enough return on investment. That's one. If the standard deposit rate at the central bank is 10%, nobody will lend you at 1 basis point less, lend money to you at 1 basis point less, because any excess funds I have are deposited with central bank at 10%.
Typically, I think the processes are still too laborious. We need to be a lot more efficient in the processes. The regulators need to be a lot more responsive on the issues, so that we could shorten the timing of the issuance of the bonds. I think cost is also an issue. It's a bit pricey, because at the end of the day, one of the reasons why you want to, why you're looking for alternative source of funding is also to look for cheaper source of funds, and if by the time you add all the fees, the advisors' fees, the fees you pay to SEC, and all those together, if it's inefficient for you, then you really haven't done so well in achieving your objective.
Not only are the corporates pointing out areas of concern, but this opinion from the subnational bond environment.
Yes, there are challenges. One is information. There is no sufficient information and knowledge, but the new management at SEC is doing so much in terms of ensuring that people or state governments and institutions are aware and the market is vibrant. Again, SEC needs to provide sufficient information on the requirements that are needed because it's a regulatory agencies. Most state governments or institutions without the proper financial background may just think that a mere application will warrant access to funding. So SEC needs to do a lot more in terms of information dissemination, in terms of developing skills of critical stakeholders in the market so that we have a seamless process and tightens control.
It appears that the approval process for subnational bond issuance remains cumbersome and bureaucratic. Having to complete an offer within a financial year for an issuing state and the long process of getting ISPO or irrevocable standing payment orders approval from the federal government remains a challenge. Another factor to consider is that bank loans, even with their shorter tenure, are more attractive as they are much easier to secure. Very much in the favor of the Nigerian bond market is the fact that it has a lot of room for growth, with a debt to GDP ratio at only 11% compared to over 200% in Japan, 110% in Singapore, 103% in the United Kingdom and the United States, and over 60% in China.
We need to address both the supply and the demand side of the market. On the demand side, there's a lot of work we need to do with investors. We need to start taking a hard look at our investor classes and really understanding their requirements, because there's quite a pocket of, for instance, investors who are more interested in longer term, longer dated instruments, while there's a huge chunk, of course, who are more interested in the medium to the short term. And we need to start looking at products that suit those specific needs. At the same time, not undermining or jeopardizing the risk, the low risk element of this instrument.
Of course, as the market becomes more sophisticated and places greater demands on participants, there will be a need for improved skills.
I think a lot of the education, a lot of the knowledge and skill building that we need to do is really more with the public sector and with our regulators. The SEC has been has been a leader, has been in the forefront of really developing skill sets. But as we move into new products, we expect that they too also will do their best to catch up. And if you look at some of the circulars, some of the guidelines that have been issued in the past, demonstrate that the SEC is very much alive to that responsibility. So I don't think it's a cause for concern, really.
Corporates and state governments are alike in their view that the bond market is the way to go to fund growth and development.
I think it should be used more, but every business has to evaluate what their financing needs are. Our financing needs, because of the nature of our business, are essentially long-term in nature. So we prefer to go after sources of long-term funding rather than short-term. So the bond is particularly suited to our business.
Oh, certainly. The Nigerian capital market will continue to grow and work stronger. This is a rapidly growing economy. The Nigerian economy is growing over the last decade at an average of about 7%. And in current year, we are seeing an average growth rate of 6.75%. So with such an economy, you need a strong capital market that can also support not just even government in assisting to raise municipal bonds, as it were, but also the private sector itself. The corporates themselves must be able to raise capital needed to, to invest in their businesses, to create job opportunities.
If you look at major sources for capital, it's either you go through the conventional banks, or you go through the capital market, or you go through investors, majorly. Now, the commercial banks, because of the short-term nature of their deposits, they usually give short-term loans. Now, for governments and institutions that plan for the long term and in view of the huge capital nature of infrastructural projects, you have to assess the capital market. Now, the long-term nature benefit, then there's also the pricing benefit.
Yes, I think there's considerable depth in the market. And I look at that depth from two perspectives. One is from the perspective of the advisory universe, those who provide advice to issuers of securities. And I think there's a growing, universe of experienced advisors in that regard. I also think that the investor audience has grown considerably. So the institutional investor market, who are the traditional investors in bonds, are also quite adept, and are very good at appraising opportunities. So I do think there's reasonable depth on both the advisory and the investment side.
Obviously for foreigners, the first thing that drives their view, always is the exchange rate. Essentially, for a foreign investor, it's a carry trade. So if I have cheap liquidity from somewhere, I can bring it in and extract my yield with some degree of currency protection. The trade makes sense. If that carry trade doesn't exist, it's then fundamentally down to people who have a very strong long-term fundamental view of the marketplace. And I wouldn't say that there necessarily as many of those as there are those investors who are basically pursuing a carry trade.
We couldn't have done what we did without the capital market. And I also believe that perhaps we are at an early stage right now in terms of how the capital market can support subnational entities, particularly in the area of infrastructure development. And I think that the future is bright and big as we continue to see more states go to the capital market.
Oh, the prospects are amazing. We're a nation where the government has identified that we need $3.9 trillion for infrastructure. How is that going to be funded? It's not going to be funded through the ordinary budget of the federal government or through the ordinary budget of state governments. It's going to be funded through the capital markets mainly. So this is a market that is probably one that will grow going forward. And probably is actually not the right word. It is one that will have to grow over the next few years to be able to respond to the needs that we have in terms of infrastructure. But also I mentioned the fact that companies need to be able to diversify their diversify their funding costs from equities to include bonds. So the opportunities are enormous, and with $30 billion of money, looking for where it can put that money, the issuers, I think there's clearly an opportunity there. I think also that as we continue to make progress in terms of macroeconomic stability in the country, as we've already achieved over the recent past a single-digit inflation rate. When interest rates start to decline, we're going to see it be probably an area of interest for a lot of issuers. So the prospects are absolutely amazing.
As Nigeria enters this blossoming economic and financial future, ongoing reforms in the capital market are key. The SEC's continued proactive, creative and dynamic approach will allow it to appropriately respond to the country's transformation trajectory, whilst ensuring continued debt sustainability. Further attention to the West African Capital Market Integration Programme and the 10-year Capital Market Development Master Plan will help to deepen and shape market activity.